Good morning, traders. Welcome to Beyond Profile. Today is Thursday, April 7th, and we just had our jobless claims number come out, and week ending 3/7 was 3.72 million versus I just missed it off the screen there. But anyways, we were flat all night, and we are in day number 5 here. Really, we could consider these two bars here too, but we've got 4 days of balance trade. And we're going to make a big move here, folks. Either we're going to go up and out of this area, or we're going to come back down to these 16 areas on the S&P daily chart here. So I'm thinking if we don't make a new high here, there was a lot of selling going into the close last night, right before about the last half an hour of the before we got to the close. A lot of selling came into the marketplace. So if we cannot, okay, there's a number 3.723 million versus 3.732 million prior week. So there's no, I'm looking to get short already this morning, this market, pre-market here. So we're going to break out of this balance. This balance area will get into an imbalanced state, which means that we either go higher outside of it, or we break down and we go lower outside of it. That's where balance leads to imbalanced state. When there's an acceptance of this current auction in this area between the unfair lows and the unfair highs, and until something disrupts that supply or demand in the marketplace, this market could continue, in theory, auctioning, back and forth through this range until the cows come home. It's just like going to a farmer's market, if you will, and you're trying to buy a bushel of apples, and the bushel of apples are costing you, let's say, $13.29. All right, on average, $13.29. You find some guys selling them for $13.35s, and you find some selling them for $13.23s. But the majority of the guys at the farmers market are selling them for $13.30, $13.29. This is where we have accepted value. Now, what happens if something disrupts the supply and demand chain of the apple market? Let's say that we have a frost of some sort, freezes all the apples, and there's not very many apples. All right, what's that going to do to our price? Okay, that's going to push us higher. Now it's going to cost you $13.40, $13.42 for a bushel of apples. Or let's say all of a sudden we get a flood of apples shipped in. All right, Washington ships in a bunch of apples to your farmer's market. Now we've got a flood of a supply. What is that going to do? Well, they're going to have to bid lower. All of a sudden now apples are going to be 3.18s, 3.19s, 3.16s a bushel. You see, so it's all based off of supply and demand in the marketplace. It's all it is. And right now, there's enough liquidity in here to meet the needs of both the buyers and the sellers. There's certainty about the market. We had an ECB announcement this morning. They're raised rates by 0.25%, and there's nothing here to disrupt the supply and demand in the marketplace right now. I mean, they're happy just auctioning back and forth in this range, and like I said, until something changes, we could continue in theory auctioning in here, for a long time, but we know that won't be the case in this world that we live in, because something, whether geopolitical, it could be a matter of the government shutdown that they're threatening. That's like 40 hours and some minutes now till shutdown. What happens if they were to shut it down? The last time that happened, if you remember, when the markets really punished the government was when we were talking about TARP back in 2009, when the first time when they voted on TARP and they turned it down and the market just went down for like 15% or whatever it was that one day. Same thing, okay? That could be the stimulus, if you will, to get this market to break out of this balance area. It'll be something like that. God fearing another tsunami or earthquake, in a country, but something of that sort that would rock the supply and demand, the fear and the greed, if you will, in the marketplace. So we're balanced, and we're balanced. In the Nasdaq, same situation here. Gold is back, broke out the other day, 1460s, kind of hanging here, and may actually get some opportunity in that. We're going to keep an eye on bond market also, the 30-year bond market. Because this is getting actually into an area that we may actually be looking to nibble. It's right at the bottom of a prior value area down here. Let's bring up that chart real quick. Here's the bond chart. You can see we're coming right back down to these lows here where we had bounced from before, these 18s, the 18 area. So the bonds might be setting up for a possible trade here back up, maybe back to 1928s or so, this breakdown area in the bond market. We'll see how the S&P and stuff fails today, but based on the way that these are coming back down, you'd almost think that we're going to probably break to the top side in these markets, as much as we might have a hard time believing that. But we're not going down, and if we're not going down, then what's the next direction that we have to test? The top side, right? So keep your powder dry, folks, and make sure that you stay on the right side of the trade. Don't put a bias on the market. Read the markets for what they're telling you and trade what you see. Trade what you see. Don't make something more out of the markets than what they're really telling us. Okay. Just always, I tell my coaching clients all the time, just trade what you see, not what the TV's saying, not with what you're reading. Just trade what you see. Okay, folks, have a great trading day. We'll see you in the room.